everyone, this is Spurti. Today I want to talk about the importance of position size. Just a quick note, all my videos until now, whether it is trading 101, price action or technical indicators, can be applied in any trading scenario and any country. I'll be focusing on some important fundamentals initially so that we have a holistic view when we enter into trades. It's always better to completely understand what you're getting into so that we don't lose all our gains drastically. Moving on to today's topic. What exactly is position sizing? It is the amount of money you invest in any particular trade. This is a super important concept which prevents you from over-risking your portfolio. Ever heard of the story of the rabbit versus the tortoise? The rabbit ran fast but crashed and burned, while the tortoise was slow and steady but crossed the finish line. The same concept applies in trading. Let's approach position sizing from two perspectives. One is the mathematical way and two is the psychological way. There are a few terms to understand. Let's say you buy Facebook for about $300 and you buy 100 stocks. Your position size is 300 times 100, that is $30,000. In future, if Facebook goes down and if you plan to sell Facebook for no less than $290, then your risk is 300 minus 290, that is $10, times the number of stocks, that is 100, which gives you $1,000. If Facebook goes up and you plan to sell at $320, then your reward is $2,000. The mathematical way is a statistical model which shows you what is the probability that your investment account reads zero. This is also known as the risk of ruin chart. Let me explain this. On the rows, you have a win ratio, that is the probability of trades that go in your direction. It doesn't matter whether you are long or short on a stock. What matters is if the trade panned out in your favor. As an example, a win ratio of 40% means that for every 10 trades, 4 worked out in your favor and 6 worked against you. On the columns, there is the payoff ratio or the reward risk ratio. This is to verify for every dollar you put in, how much did you make? Is it $1, $2, $3, etc. In short, it's the average of your winnings or gross profit divided by the gross investment. It is always important to get feedback on how your performance is when it comes to this profession. Just like how in your jobs you would have your annual performance review and improvement strategies are discussed, it's important to look at yourself every quarter or so to see how well you're doing. I would highly recommend journaling each and every trade of yours to understand how well you perform. Coming back to the risk of ruin, let's deconstruct this briefly. Using 10% of capital at risk per trade, if you are 35% accurate and have a reward risk ratio of 2:1, you have a 60.8% chance of losing all your capital. However, if you can increase your edge or your accuracy by 5%, you only have a 14.3% chance of losing your entire account. This shows the power of increasing accuracy ratio to gain a greater edge. Now let's take the same accuracy ratio of 35% but increase the reward risk ratio to 3:1 from 2:1. What this does is turn your 60.8% risk of ruin to 8.2%. So in actuality, this gives you a tremendous edge. But here is the challenge. In trading, it is actually harder to increase the profit target from 2:1 to 3:1 than it is to increase your accuracy ratio of 5%. 10 to 20% accuracy ratio is a big shift and much harder to achieve, but 5% is not a big shift. Over 100 trades, you only have to win 5 more or you have to win 1 in 20 more. But to increase your profit target from say $100 to $150 becomes much harder simply because you're trying to capture maximum movement of the stock during the day. This requires more precision in your entry. Now let's take the other side of this equation. Let's say you are 35% accurate, not too demanding for accuracy, and have a 3:1 reward risk ratio. You will only have an 8.2% chance of losing all your capital. However, if you're like virtually everyone else learning how to trade and you take profits early, say 50% of the time, how does this change the mathematics? It turns your risk of ruin from 8.2% to 34%. So now you have a 3-in-1 chance of losing all your capital. Not bad, but definitely less stable. This is assuming that you're perfect in taking profits at 3:1 reward risk ratio 50% of the time and 50% of the time at 2:1 reward risk ratio. To summarize, lowering your position size in trades, increasing your accuracy are the things you can definitely do to reduce your risk. However, reward risk ratio all depends on the market conditions. Moving on to psychological aspect of trading, as lots of us are geared up differently when it comes to money. Let's say you have $100,000 portfolio. Some people are comfortable risking $10,000 while some people are comfortable risking $1,000. If you're a person who is comfortable with losing $1,000 and you went into a trade with $10,000 risk and you lost, psychologically this can have devastating impacts. You develop aversion to trading. You tend to become miserable. You tend to blame the market speculators or curse your luck. Worst of all, your misery has a fallout on your family. We definitely don't want to be in the state. We always want to be in a state where even if we lose, then no worries. We will try again tomorrow and move on with your day. There's no significant impact on your behavior or your internal state of being. One quick way to test if you're psychologically compromised is to ask yourself, can you laugh at your loss? No one likes losing in trades, but the nature of trading has its up days and down days. So ask yourself, how much are you willing to lose today so that you may make money in the long run? 2, you don't become emotionally compromised. And 3, you're not going to quit trading. If any of these conditions are violated, you're probably over-risking in that position. In short, risk of ruin table could help you determine what should be your risk tolerance based on position size. However, this method only works when it has sufficient number of trades. Hence, journaling your entry and exit from trades gets you there. He or she who controls the risk wins in this game. Let me know what you think and provide your feedback in the comments below. If you like this video, don't forget to like, share and subscribe and hit that bell icon for more videos on financial literacy. Thanks for joining me today and I'll see you all in my next video. Bye-bye.